With over 27 different countries, currencies, political systems, and economic backdrops, we believe emerging markets, or EMs, require a fundamentally different approach to investing than in developed markets. Over the past decade, despite mild performance from broad EM and frontier indices, the world's top performing country was always from within emerging or frontier markets, whether it be in 2012 Kenya, 2013 the UAE, 2014 Kenya again, 2015 Hungary, 2016 Brazil, 2017 Argentina, 2018 Qatar, 2019 Russia, 2020 Korea, 2021 Kazakhstan, or last year, 2022 Turkey. Opportunity set is large but nuanced, which means that being in the right names and countries and sectors can be vital to performance. From a passive perspective, our experience has been that emerging market or EM benchmarks tend to lean towards large cap national champions and state owned enterprises or SOEs. SOEs are generally government owned influence companies operating with a broader set of interests, appealing more to their political and socioeconomic interests rather than those of minority shareholders. By our estimation, these companies represent roughly 25% of the MSCI Emerging Markets Index. Emerging markets benchmarks are also typically backward looking in their methodology, in our view, significantly weighted towards historical drivers of growth rather than smaller, innovative companies that may have the potential to capture future returns. This could translate into indices and therefore the strategies that track them, missing out on dynamic opportunities, especially if these EM companies decide to list on US or UK exchanges, as companies that list on exchanges outside of their home market are not included in EM country indices. Passive strategies tend to carry regional concentration risks, which create inefficiencies that active managers can exploit. Asia represents about 80% of the emerging market, or EM benchmark. So if the average global equity investor has a 5% allocation to EM, then they only have 100 basis points dedicated to all of Latin America, all of emerging Europe, all of the Middle East, and all of Africa combined, which means that many opportunities can be overlooked. Concentration risks come in smaller countries as well. In one-third of the dozens of markets classified as EM by MSCI, more than half the market cap is in a single stock. In Colombia, the UAE, Indonesia, Chile, Mexico, South Africa, Russia, Poland, Saudi Arabia, Turkey, and the Philippines, 50% of market cap is concentrated in fewer than 5 stocks. So with that said, investors may not benefit from the diversification that's generally associated with passive strategies.